On April 11th, the SEC held one of its most important crypto roundtables yet, part of a 5-event series designed to shape the future of digital asset regulation in the US. This session focused specifically on crypto trading platforms, and for anyone trading, building, or operating in the space, what came out of it could change everything. Because not all of the news was good. Let's start with the big picture. The SEC knows that traditional financial rules don't fit crypto one-to-one. So instead of enforcing the old model, regulators are now looking for ways to tailor the system and possibly offer short-term relief that allows platforms to continue operating without breaking the law, while long-term rules are still being written. This is a huge shift. Acting SEC Chair Mark Uyeda proposed something traders should absolutely know about: a time-limited conditional exemptive framework. That means the SEC could temporarily allow certain crypto activities, including some forms of trading, as long as basic conditions like risk disclosures and custody standards are met. This would be a way to keep markets active without forcing every platform into a full broker-dealer setup overnight. For traders, this could mean continued access to tokens and services that might otherwise have faced legal uncertainty. Another major takeaway: regulators recognize that many crypto platforms handle multiple functions: trading, brokerage, clearing, and custody, all under one roof. In traditional finance, those are separated. Commissioner Caroline Crenshaw warned that this vertical integration could create hidden risks or conflicts of interest, like platforms trading against their users or lending out customer assets without clear permission. If you're trading on an exchange that also acts as your custodian and your broker, you might not be protected the way you think you are. This is why the SEC may start requiring clearer separation of functions or stronger internal controls for multi-role platforms. Regulators still see control as essential. What do you think? Let me know in the comments. Now let's talk about token listings, a legal gray area for traders. The panel discussed how platforms today often list assets that could be securities and others that aren't, like Bitcoin or Ethereum. The problem? US law splits oversight between the SEC and the CFTC, but crypto markets don't work that way. They mix everything. The SEC acknowledged this is a problem and is actively exploring a unified licensing regime. That would mean one federal license for trading platforms to list a mix of assets, which could finally give traders clarity on what's legal to buy, sell, or hold, especially when it comes to smaller or newer tokens. The SEC also made it clear that decentralized trading platforms like Uniswap won't be treated the same as centralized exchanges. The architecture is different, the risks are different, and the regulations will need to reflect that. So, if you're using DeFi protocols to trade, the good news is that the SEC isn't looking to force them into centralized compliance models. Instead, the focus will likely shift towards smart contract transparency, fair access, and proper disclosures, things traders can watch for to gauge the safety of a platform. And if you're wondering whether you're at risk of using an illegal platform, here's what you need to know. The SEC is now focusing less on shutting everything down and more on setting clear expectations. They want to ensure platforms are transparent, properly managing user funds, and not giving unfair trading advantages to insiders. As a trader, this means you'll want to stick to platforms that can clearly explain how they handle custody, front-running protection, and whether they follow any kind of compliance framework, even if they're not fully registered yet. The platforms that are playing by the emerging rules are the ones most likely to survive long-term. One of the most important voices at the roundtable, Tyler Gellesh, emphasized something that directly impacts traders: knowing who you're trading with. Today, many platforms don't require identity verification, which can open the door to wash trading, market manipulation, or other forms of fraud. Regulators may soon require platforms to implement more robust KYC processes, not just for onboarding, but also for counterparties and liquidity providers. So, expect that more exchanges, even non-custodial ones, may start requiring more user identification, especially if they want to remain on US soil. Another key point: representatives from the New York's talked about how crypto ETFs are giving investors a safe and regulated way to gain exposure to digital assets. This could mean a future where traders see more tokenized versions of assets, or even entire trading platforms that look like traditional stock exchanges but deal entirely in crypto. That hybrid model might be where everything is headed, regulated enough to offer safety, but still crypto native in structure. Lastly, the SEC made it clear that this isn't a one-off conversation. Subscribe to the channel and stay tuned to be informed about the next roundtable. We will be covering everything from custody and tokenization to DeFi and stablecoins. If you're a trader, builder, or just someone who wants to stay in the game, now's the time to pay attention and even get involved. The rules are being rewritten, and knowing what's coming could give you an edge most people won't see until it's too late. Stay informed, and as always, stay curious and stay hodling.